Thank you for being here for our Business at Breakfast series. We're a couple minutes early, but we'll go ahead and get started. We got a great turnout here this morning. So thank you all for coming out on a Friday morning. This morning we have with us Matt West, who is the Chief Strategy Officer at MVB Financial Corp. And the President of MVB Edge Ventures. And also Stephen Saab, who's the Director of Portfolio Operations at MVB Edge Ventures. And they're here today to talk to us about cryptocurrency. We had a lot of questions from our members, and we said, okay, great, we got to find a speaker, and these two gentlemen stepped up and volunteered to be here today with us, so we thank them. So we'll let them take it over, and we'll have questions there at the end. Get you switched over there.
And as they work that, the way we have this laid out, it's been a long time since I stood behind a podium, so it won't last very long. Open for questions throughout. We'll talk through an agenda here. So we try to break up a little bit blockchain and then the different use cases of blockchain. If you have specific questions within any of the topics, feel free to ask them as we go. You don't have to hold on to them. If you're like me, I tend to forget by the end of the presentation, so you can feel free to jump in. In terms of how much content is in there, there's maybe, if I read every word, it could take a while, but I don't plan to do that. So maybe a half hour worth of content, which means we have plenty of time for questions. This is intended to be a 101. MVB started supporting a few crypto companies probably about 4 years ago. And about a year ago, we realized we needed to hire an expert. Neither of us are that expert. We have familiarity, but this is a topic that can go incredibly deep. It's evolving may even be too soft a word. It's changing very quickly. But I think we'll generally be able to give a pretty good overview. And like I said, please feel free to ask questions anytime. It'll break the monotony of our voices. So before we start, anything that you got to get out with a question right away? Bitcoin is down about 5% in the last 24 hours, and we'll start there. Okay, it's a normal day. So first, we'll start with blockchain, and blockchain is the technology that is underlying all the different use cases that we'll talk about. I do start off with a handful of slides that are a little bit more text heavy, so I will pick a few out of here. So a few key pieces of it. Distributed ledger, take each of those two words. Distributed means it can be spread across many, many different nodes or many different computers, many different people. Ledger meaning it keeps track of transactions. So those are the two key components of it. Bitcoin is sort of the first prominent use case of blockchain, and that was 2008, 2009 timeframe. And that's why a lot of times when you hear blockchain, Bitcoin, and crypto, they'll get mixed together. And main reason being Bitcoin is still probably, I said, one of the earliest prominent use cases and still one of the ones that's most talked about. A few key characteristics that will hit. Digital signature or code execution, meaning it's all digital. The blockchain or hash linked data structure, think block and chain, two key pieces. The way it works, it's a chain of blocks. So one transaction happens, the next transaction that happens links on to that block or references the previous block or blocks, and it just continues to build and grow. So over time, you have one really long list or ledger of what's happened. And then the consensus mechanism, that's, especially as we get into the cryptocurrency, that's how you prove, accept, or verify or validate that a transaction's happened. Consensus meaning other people inside of the distributed piece of it. They are reaching consensus, they being not necessarily people, but computers, are reaching consensus that the transaction is verified. So those are three key pieces. The other pieces, other bullets there summarize a little bit more of what I've said. Once a transaction is validated, it's final. You can't necessarily undo. There's no undo button or key that you can hit to make it go away. You can do another transaction that may reverse it, but that particular transaction is permanent. I think those are sort of key pieces. Other things we'll talk. We're going to talk more about proof of work and proof of stake. Those are the two primary ways. Previously I said the computers reach consensus that it's a verified transaction. Proof of work and proof of stake are the two primary ways of doing that, and we'll cover those a little bit more here shortly.
And I think one thing to add, I know we're talking about cryptocurrencies 101 was the topic, but starting off with blockchain, that underlying technology, at least me personally, I find the blockchain technology much more interesting for what it could potentially do compared to when you just hear about cryptocurrencies or Bitcoin. Obviously that's driving a lot of the news and headlines, but the blockchain technology, it's in a lot of cases, and we touch on this later as well, but you'll hear the difference between Web 2.0 and Web 3.0, and that's not just driven around the currencies, but how many different ways can we apply this distributed ledger blockchain technology for use cases we haven't even come up with yet. I think Mark Cuban compared it to back when the internet was starting. Someone came up with the idea for internet radio, and at the time, everyone's like, well, that's dumb, I have a radio, what do I need that for? And now you think about, Spotify, Pandora, all these things, and, they're more popular than the radio, right? So there's all these use cases. Think about it being in the very early innings of how that can be applied, where it'll seem obvious in, who knows, if I knew, be making a lot more, right, across the board, and we'd all be rich. But so many use cases that will seem obvious in 5, 10, 15 years still to come, and it may not just be Bitcoin, right? That's the blockchain technology separate from cryptocurrencies in general.
Okay, this is a diagram that we proudly borrowed of how the Bitcoin blockchain operates. So Plan Inspector, there's a transaction that gets requested, and a block is created that's going to represent that transaction. Then that block gets sent out to every node in the network. So think node are computers. For simplicity, we'll just refer to them as computers that are running the blockchain program. In this case, the Bitcoin program. Some nodes, so not every node, but some nodes will validate that transaction. The ones that do receive a reward, and then that block is added to the existing blockchain. So think it was created but hasn't been added to the entire blockchain yet. And once it is added to the blockchain, then you think that transaction is complete. So one of the things that you'll hear about Bitcoin, one of the downsides, if you're using it for everyday transactions, if you wanted to walk into a store and pay with Bitcoin, there is a decent amount of time. The process for this to happen is probably, I think it's close to 10 minutes or so. So it's not instantaneous because there is the process of validating the transaction. There are a couple different ways that you will have the feeling of buying something with Bitcoin. When that's happening, usually one of two things are occurring. There's a new technology called the Lightning Network, which moves some of these transactions off of the primary Bitcoin blockchain. The transactions are happening, and then think it's reconciling back. What you also see are intermediaries taking some of the pricing risk or volatility risk associated with Bitcoin. So we support a couple of pay with Bitcoin type programs. What's actually happening is there's some entity that's holding the Bitcoin in custody. I'll describe one that we've had that we'll be launching soon. So if you wanted to pay with Bitcoin at Home Depot, you walk into Home Depot, you get your bill, comes up, eventually you're going to see where you see the option now to pay with a card, to pay with cash, pay with a check. You eventually see one that says pay with crypto. You would push the button, it'll generate a QR code. If you have a cryptocurrency wallet with this particular vendor, crypto.com, they would look at your QR code, they check your balance to make sure you had enough crypto. They would execute the trade to get you out of crypto into cash, and then they would settle the cash with Home Depot. So in that case, I think you're not paying directly with it. There's someone behind the scenes that's executing a trade, and they may settle instantly and or multiple times throughout the day.
So they may be engaged in an illegal transaction.
A, legal?
An illegal transaction, if it's not Home Depot, say you're buying something else that's illegal.
Well, the merchant would have to sign up, so it's only merchants who have signed up. So they would have to sign up an illegitimate business in order for it to be illegal. Go ahead here, then I'll get you, Frank.
You know, that the middleman you just described,
Mm-hmm.
do you know, are they hedged, and if so, how they do it?
So many of them operate trading desks and institutional trading as well, so they're hedging for this particular product, probably not. But for some of their other holdings, they would be. I'll come back to.
Offset a big fall in Bitcoin or whatever the crypto was that they're acting as a middleman for. That's what I was thinking of. If their operation is big enough, they could conceivably have a lot of transactions happening at one time, hold a whole lot of crypto, and then if you had an incident where it falls a lot in a really short period of time, I was just curious whether they were protected from that in some fashion.
Yeah, I could dig a little bit more. I believe for this particular program, probably not. But yeah, there is some with that timing risk of it.
So timing risk and payments, what are your thoughts on Ripple as it shows up in the news more and more and more and more as the SEC lawsuit looks to be close to finished? What are your thoughts there from a payment processing opportunity? Do you guys see the insight into that?
Yeah, we'll probably cover that a little bit more with stablecoins. So Ripple is a company. Ripple is also a cryptocurrency. XRP is the cryptocurrency. Ripple was primarily founded for the intent of being using the XRP as a payment instrument, or I don't necessarily call it stablecoin, but as a payment instrument, and very much focused on the international component. They're trying to take out some of the fees and timing constraints, or not constraints, but timing lag that happens with international transactions. So sort of separate out. Then the lawsuit, which is, there are now a few lawsuits out there for particular cryptocurrencies as to whether they're considered a security or not. So that's the lawsuit that Frank referenced. That's probably a year and a half, maybe 2 years in the making, that may be coming to a close. But that's, I sort of separate that lawsuit from the business that Ripple is trying to facilitate. So if they had really good traction, they had a really talented team that we were working with up until the lawsuit. What they're trying to solve for is, to answer your question, what do I think about it? I think what Ripple is trying to solve for is well worth trying to solve for, especially the international component of it. The fees associated with international money movement and the amount of time that it takes is within financial services is still probably one of the most inefficient processes. So that piece, I definitely think it's worth solving for. They'll need to make their way through and out of the legal situation in a favorable way in order for them to re-engage with some of the large brands they were previously working with.
So is it true, though, that the BRICS nations have openly adopted more and more Ripple's payment processing methodologies?
I think it'd be a little early to say that they're openly adopting it. For any particular currency, and specifically Ripple, I think that's early to, or I would say that's not true yet. Come back, we'll run through the cryptocurrency specific use case of blockchain. Think of it as digital asset. The cryptocurrency is a digital asset, and it's used as some medium of exchange, and you can use and or trade those digital assets. Bitcoin is one of those cryptocurrencies. Ethereum is an open source blockchain, and it's decentralized, and it has its own currency or cryptocurrency called Ether. So these two are the two most popular. When we get into talking about decentralized finance and dApps or decentralized apps, many of them are built on top of the Ethereum platform. So of the three, of the three, these are two of the biggest. Solana is another one that's larger in scale. This is another image that we borrowed. Quite a few of the Bitcoin fanatics out there really think of Bitcoin as the future of money, and there's a very technical economics book called the Bitcoin Standard. If anyone ever picked it up and thought it was going to be about the technology Bitcoin, it's 9 chapters of Austrian economics and then 1 chapter about the technology. So there, for many of them, people who are very much bought or love Bitcoin, it's because they believe that Bitcoin is an excellent store of value, similar to gold. So the book is sort of comparing and contrasting the gold standard and their belief of the Bitcoin standard. And the reason being is it's easy to exchange. You can control the rate at which new Bitcoin is introduced, and there's a finite supply. So it's not as though any government can just print more money. The amount of Bitcoin that will be produced over time is finite. So for that reason, they believe that Bitcoin over time will prove itself to be a money and a hard money or a good money. So this one, as you see, the Bitcoin piece down there is they pulled from that, and they sort of build up on the different ideas of how money has worked, what it was used for, where inflation came in, the downfalls of certain types of money. So, this is just the text version of the previous one. And then here's a brief history of crypto, and I think we'll move on to the next section. So I mentioned 2009, this was Bitcoin. You hear the pseudonym Satoshi Nakamoto is recognized as the founder of Bitcoin, or the creator, along with a few others. There's, for some of the story piece, whether that's an actual person or group of people, no one specifically knows. There's no proof exactly who Satoshi is. Frank mentioned Ripple, that was 2012, so shortly thereafter. Bitcoin in 2013 made it to $1,000, which at that time was a landmark. This morning it's 23 or 24,000. It's been as high as, I think, in the low 60,000s. You see EOS, Ethereum launched in 2015. And then many people are very excited, the decentralized finance, which also leads into some of the Web3 applications that Stephen mentioned. So still very early. This is 13, 14 years old. Many people compare it to the history of the internet. You think of where the internet was at 13 years old. Most people didn't know about it. Maybe there were a few people with modems. Just about the time when AOL sent you, for those who may remember, the little CDs in the mail and tried to give you 5 free hours. So still very, very early. Then I'll hit one of the last few things to talk. Why people like cryptocurrency. Privacy sometimes. Not all cryptocurrency transactions are private. Most of the exchanges, especially the ones that operate in the U.S., they're known. Like there are no anonymous for many of them, there are no anonymous transactions. Yes, there's some exchanges, there are some transactions where it could be anonymous, but the majority of them are not. There are a number of FBI agents on record said, I wish everyone would use cryptocurrency because I can track every single transaction from where it came from and who it went to. It's way easier than trying to track cash. So if you think of it, privacy, possibly, but the majority of cryptocurrency transactions out there today, the one I mentioned of the Home Depot example, that absolutely would not be a private transaction. The user would have had to go through KYC just like they would at a bank to get a bank account, and they would know who was making that transaction. So privacy, partially. Access, probably this one holds more true, and you hear some about BRIC countries, or that's Brazil, I lost some, India, China, I forget what they are, Russia's the R. So for, especially you'll see it some Asian and then South American countries, some of the poor countries, where they've had high inflation in the past, banking systems not quite as mature, you will see higher adoption of cryptocurrencies in those countries, especially if they, one of the main use cases you'll see just sending money or sending value back and forth. If they have family members in the US or a more developed country, and they're looking to send funds to someone in a less developed country, that's one of the common use cases of some cryptocurrencies today. That's easier sometimes than going to Western Union or MoneyGram and trying to send funds that way. So getting access to many unbanked individuals. The security piece definitely does fit. You'll see that quite a bit. It's programmable, so you get into the smart contracts, so you can start to build some logic, which makes it even more efficient, leading into the last one. So number of use cases or reasons to use cryptocurrency.
I have a question. How is this taxed, or is this tracked by the IRS, or how is it?
The IRS does attempt to, over the last couple of years, taxing cryptocurrency trading, and it would just be your gains and losses are being taxed if you're reporting. But the reporting is the tougher piece of it. So if you use TurboTax, one of the questions, if any of your TurboTax users, this year they introduced the question, do you buy or sell crypto?
But it
So
would only be on the public transactions. They wouldn't know unless you're supposed to.
yeah, at this
disclose
point, you're self-reporting. There's not a good audit trail backwards for someone else to report in. So the popular exchanges now have that information and are getting the requirements to share that information. But there's still, if you really wanted to avoid being taxed on your cryptocurrency trading, you probably could find a way still to do it today, but over in the next number of years, it'll continue to be harder and harder. You'll find a way to avoid taxes, but cryptocurrency trading will be similar to others. That in the future, you'll be taxed, and
Right.
that's part of the reason why it's some of the pay with crypto type products haven't gained as much traction, because if you're getting in, every time you're doing a transaction, it's considered similar to a trade, so your tax is being calculated, and we as individuals are responsible for keeping track of it and reporting it, so that makes it a little bit, that's one of the factors that it gets attributed to why it hasn't become more of a daily use of cryptocurrency as a payment method.
Yeah, that's definitely been one of the biggest holdups in the U.S. for that. If you think about going to Sheetz and pay for a couple gallons of gas, and right now it's like the equivalent of, let me go ahead and cash out some of my stock to pay for this, and it's like, well, there's my gains or losses just to pay for a tank of gas, right? Now that is just in how the U.S. is trying to wrap its hands around it, trying to figure it out. Other countries where they're adopting like Lightning Network, you go into a McDonald's and you can pay for it. It's not treated the same as it is here. So that is the current U.S. view on it, but internationally, emerging countries where you see it more broadly adopted, different tax look there, trying to treat it more like a true currency as opposed to, in the U.S. it's more digital asset, like a stock almost.
So here, just some of the different similar slide as previous, some of the different currencies and how they're cryptocurrencies and where they're being used. All right, I'll start to pick up the pace a little bit just based on timing. So surge in interest, want to mention it is still early, just generational shift in wealth. So some people are just looking at different asset classes, and it's not always completely rational. So some of the cryptocurrencies they had the cycle when it ran up, and that generated more interest, and those cycles feed themselves, so it fed itself on the way down as well. The network fundamental, meaning it's easy to move it around. More and more now you see Bitcoin just trading like a risky asset class. So there is some diversification even. So that one is where we see just some of our really large just business clients. They're putting some portion or evaluating putting some portion of their cash in different assets. They think, I'm going to put some in treasuries. I may put a small portion of it in different cryptocurrencies. So you'll see some large insurance companies, they have a portion of their holdings are in cryptocurrencies. So that's part of what drives it, and it's just additional asset classes. And then there is excellent liquidity. There are plenty of markets, there are plenty of exchanges where you can 24/7 be getting in and out of your crypto positions. We'll run through risk. Clearly volatile. I joked Bitcoin up or down 5% in the last 24 hours. I use Robinhood is one of them that I use for trading. So get the alert. It's probably at least 3 times a week. I get an alert whenever it's up or down 5%. So at least 3 times a week I'm getting an alert. Definitely volatile. There are some larger hacks that have happened, not necessarily with Bitcoin, but some of the other exchanges, some of the other currencies. These are not FDIC insured funds, especially as a bank presenting this. Your crypto is not FDIC insured. There is a pretty decent, one of the crypto companies, do you remember the name? Celsius, I think it is, that failed here recently. A number of people had their funds with Celsius, so they put cash or fiat, so US dollars in. They bought cryptocurrency. They're using different, some of them were staking it, some of them were just being held. Celsius, through some of its other business activity, was running out of cash. So they froze access to all those accounts. So their users were not able to cash out their cryptocurrency positions. So they, in fact, can't get their money out, and now they're waiting on the legal proceedings to play out to figure out how much, if any, of their money that they'll get back, their dollars they'll get back. I mentioned hype can be up and down. And then regulation, especially in the U.S., still to be determined how that all plays out. A number of different ways that it could go. I'm not going to get too much on Satoshi distributed ledger. We talked a little bit about the idea is there are multiple nodes. I think that today the current U.S. banking system, you have a bank in the middle and then multiple clients. And then you have the Federal Reserve Bank, even more so right there in the middle. With a decentralized ledger, no centralized authority. It's the program that is driving it. This is going a little bit. All right, we'll talk a little bit. I'm going to pause here. So I think a lot of this was about cryptocurrency, and that was the initial conversation. From here, we're going to go into other use cases, but anyone want to have more questions on the cryptocurrencies side of it? And you can feel free if you have questions that come up later, but anything that was pressing you want to make sure that we hit.
I think one note to add to talking about cryptocurrencies at large, I think it's important to understand Bitcoin, Ethereum, all those that you're hearing about. Every cryptocurrency has its own use case for even what it was built and designed for. So Matt was referencing the people thinking foundationally about the Bitcoin standard. They are all about Bitcoin and its use case to become a decentralized currency, not relying on governments and banks and other centralized parties, right, to provide access for everyone. That's what they're focused on. That's what it was built for. And that's different than the Ethereum network, which was built as open source access for other use cases. So people develop, you'll hear even something, going from people's life savings and things like that trying to become currency to people will build a video game that uses Ethereum blockchain. So that way things that happen in the game are distributed across everyone. Obviously much less impactful in the sense of it's not someone's life savings, it's just a game that they're playing, but it's a new way that they're playing the game, and it's still using the same technology underlying there, but it's built different cryptocurrency, different use case. So then when you hear about all these different cryptocurrencies, Dogecoin and all that, those, I won't say what they're technically or commonly referred to, those are, people that are really focused on Bitcoin hate those because it just distracts. It's people building their own, trying to get on that hype train that was mentioned earlier. So, when you hear about different cryptocurrencies, try to get a sense for what is that one trying to do, what's the purpose of it, because they're not all doing the same exact thing. They're not all built the same way. They're not all focused on the same thing. So just an important thing to note.
Yeah.
Something I never could wrap my mind around. So when you're talking about like somebody assets,
Mhm.
say someone would sell real estate or they would sell their gold or they take their cash and buy a Bitcoin,
Mm-hmm.
and then that's a digital asset. What exactly are you giving your money for? What are you actually anything, or what is it you're buying? You're just kind of like buying a gift card. You take your money, you got a gift card.
Yeah, in some ways, yes. I mean, you're paying for a virtual coin, or so you think of it as a gift card, and you believe that that coin will have value over time. Either hold its value, may increase, may decrease, but if you're the person who's buying the digital asset, then you're really just buying a digital record of having that virtual coin. But if you're going to do that, you would have to have some conviction that that virtual coin will have value over time.
And one of the
It'd be hard to see people using that at this time.
Yeah,
That's their everyday thing. I mean, like, if Bitcoin dropped dramatically one day, so you go to the grocery store and now you're paying $7 for bread instead of $1 for bread because, I mean, it's just like you're.
yeah. One of the common occurrences, I'm gonna say, if you go to an ATM and it's going to draw down the balance of your bank account and you get paper, why is that paper worth anything?
Well, it comes to U.S. doesn't it, right?
Right. So, you have, this is the difference is the U.S. says the paper is worth something. In this case,
Behind Bitcoin it says.
correct. There's the other people who own it. Yeah. So that's a big. And you hit on the key piece of sort of decentralized and centralized. So.
That's really where a lot of the creation of Bitcoin, the white paper, the idea behind it is exactly that. They'll say the exact same thing of, if you go to your bank account right now, there's not a big pile of money sitting somewhere with your name on it. It's a digital record that the bank and the government are keeping record of. And the whole idea with Bitcoin is that instead of a limited number of parties, it's if we're all nodes on the same network and we all are looking at the same ledger, everyone has the same copy. So if I give Matt a Bitcoin and everyone in this room takes record of it, and then someone says, no, that's my Bitcoin, not yours, everyone else in this room would say, no, we all are looking at the same thing. That's now Matt's, it's not yours. As opposed, so everyone has a copy of the record, essentially, as opposed to,
A small number of centralized resources.
Yeah.
Yep, good.
When you said that it was very volatile
Mm-hmm.
and it went up and down, what is the basis for it going up and down? What is it based on?
So it's similar to any trading market. So it's just what one person is willing to pay for it and what the other person is willing to sell it for. So so that's fundamentally that's what it's just a trading market. What has happened over the last year or so, for a number of years, some of the proponents of Bitcoin would say that it's not correlated with the broader market. So they would say it's not correlated with what's going on the U.S. economy or some other economy. It's not correlated with bonds. But over the last, I'd say, as more institutions have started taking positions, that brought in some more professional traders, and now I would say it over the last year, it has traded, or prices have fluctuated or started to become more correlated with just other risky asset classes. But in the end, it's just what one person is willing to pay for it and what one person is willing to part with.
What is the additional cost to have that managed?
Yeah, so it would depend on how you were holding and or trading those. So if you sign up with a public exchange, so Coinbase, Kraken, they have trading fees that are typically some percentage of the trade. Robinhood now, so if anyone uses Robinhood, is all about their some level of free trades, and then they of course have their trading that comes with a cost. But you can trade a few cryptocurrencies a day for free with Robinhood. There's no cost to hold, no cost to trade. I just saw this morning Interactive Brokers is now or will soon begin to offer cryptocurrency trading, and their fees will be somewhere between 10 and 20 basis points, or 0.1% and 0.2%. So that cost to trade continues to come down. There are options if you're highly technical, then you could, in theory, load up the Bitcoin program on your personal computer, get your own wallet, and then send money back and forth to someone else. And in that case, you're not reliant on any of the exchanges, and in that case, you don't have to pay any of the exchange fees. We'll team up, for instance. So the first thing, it's easy for me to remember saying cryptocurrencies, but you also hear them called coins, tokens, or digital assets, cryptocurrencies. So they're any of those four, but the behavior is, and again, over the last 12 months, there has been a lot more trading of them.